from Ohio. The only way they can pass this bill is by creating and sustaining a panic atmosphere. That atmosphere is not justified. Many of us were told in private conversations that if we voted against this bill on Monday, that the sky would fall, the market would drop 2,000 or 3,000 points the first day, another couple thousand the second day, and a few members were even told that there would be martial law in America if we voted no. That's what I call fear-mongering. Unjustified. Proven wrong. We've got a week, we've got 2 weeks to write a good bill. The only way to pass a bad bill, keep the panic pressure on.
On this vote, the yeas are 263, the nays are 171. The motion is adopted.
This bill fails to address the fact that millions of homeowners are facing foreclosure, are facing the loss of their home. This bill will take care of Wall Street, and the market may go up for a few days. But democracy is going down here.
There was little investigation, and they asked the Treasury, where did you come up with the number $700 billion? Well, they answered it last week in Forbes magazine, and here's the Treasury spokeswoman's quote. It's not based on any particular data point. We just really wanted to come up with a really big number. Well, they succeeded.
Good evening, ladies and gentlemen. It's a real pleasure to be back in Munich. This is the third time I've had the opportunity to speak at a DEG event, and I'm very honored to be invited back yet again. David, if you could take care of the slides for me, I'd appreciate it. Peter said I'm going to be short tonight. I'll talk about 10 or 12 minutes and to the point. The point that I want to make this evening, I'm going to tell you right now. It's basically that the euro is not the Deutschmark. The ECB is not the Bundesbank. Once you recognize that and understand that, you'll understand the reasons why you need to own gold and silver to help protect the tough times, help protect your wealth and your assets against the tough times that we've got coming. David? I always like to begin with this table. This is the price of gold appreciation against 9 of the world's major currencies over the past 10 years. There's very little red on that table. Gold continues to go up. But the reality is that it's not that gold is going up, it's that the purchasing power of currencies is going down. And the interesting thing about this table, regardless of which major currency you look at, double-digit rates of appreciation against all of those currencies over the past 10 years. I want to put gold into its proper perspective. You know, a lot of people call gold an investment. Gold is not an investment, it is money. It's fundamentally different from an investment, and I want to use this little table to explain that point. You know, with investments, they're wealth-producing assets. They generate wealth. They generate cash flow. You know, if it's a farm, if it's a timberland, if it's a factory, if it's an oil well, it generates wealth. Gold is just a sterile asset. It has no cash flow. It doesn't generate wealth. It protects wealth. That's why it's money. So when you're talking about gold, you're not talking about investing in gold, you're talking about saving gold because gold is money. So when you're looking at, not yet, when you're looking at gold, it goes into the bottom part of your portfolio, the liquidity part of your portfolio, and when you're evaluating whether you want to own gold, you evaluate it against other currencies of the world, other monies of the world. Keep in mind that even though we're not spending gold as a form of currency, although we're starting to do that now in gold money, gold currency can be, when you have money, you can do two things with it. You can save it or you can spend it. We're in a stage, because gold is undervalued, you want to continue accumulating it, you want to continue saving it. At some point in time in the future, I tend to think it's probably going to be 2013 to 2015, which is my long-standing forecast. We're going to be spending that gold, we're going to be buying undervalued assets, and we're going to ride the next boom-bust cycle. Thanks, David. This next chart, I want to use this to explain why gold is money. This is the price of crude oil against 4 different currencies, and I'm using a base 100 analysis here. In other words, I'm going back to January 1950, and I'm going to show the change in the price of crude oil on a base 100 analysis, starting at 100 against each of these four currencies, so you can see exactly what's happened. This is the price of crude oil in terms of the British pound. Go ahead. This is the price of crude oil in terms of the US dollar. And what you can see right there is that as bad as it's been for the US dollar since 1950, from inflation, debasement, and all of the problems that we faced, it's even worse for the British pound. The British pound has lost more purchasing power because we're comparing both currencies against the same standard, a barrel of crude oil. Okay? The third currency is the euro, and prior to that, the Deutschmark. And I want to focus on this for a second because this is critical in terms of the point that I'm making this evening. Look at the chart at the bottom there, from 1950 until 2000. You can see that over that period of time, the Deutschmark preserved purchasing power very, very well. It basically had in 1970 the same amount of purchasing power it did back in 1950. That's very, very important to understand. What's also important to understand is look what's happening to the euro from 2000 to the present. It's looking more and more like what's happening to gold and silver, and I'm going to come back to that in a second. But before I go to the next chart, go ahead and click. This little red line on the bottom, that's the price of crude oil in terms of gold. An ounce of gold buys the same amount of crude oil it did today, the same amount of crude oil it did back in 1950. This also explains why gold is not an investment. If you can buy the same amount of crude oil today that you could 60 years ago, who wants an investment like that? You want an investment that's going to increase your wealth. Gold does not increase your wealth, it preserves your wealth. Gold does what money is supposed to do. It's supposed to preserve purchasing power over long periods of time and enable economic calculation. Calculate the price of goods and services with gold, and you get a very clear picture as to what's truly happening with our monetary system today. Now, I want to focus on this next chart, the price of crude oil from 2000 to the present. What I've done here is I've taken a base 100 analysis, but not back to 1950, back to 2000 when the euro was created. And you can see the price of gold continues to go, the price of crude oil in terms of gold continues to go basically sideways. But look what's happening to the euro. The euro is looking more and more like the dollar and the British pound. The euro is being debased. And we had the wake-up call last May after the politicians got together during the Greek crisis. And on the following Monday, Mr. Trichet said he's going to start buying government bonds. That broke the promise that the European governments made, that the European Central Bank was going to act like the Bundesbank and that the euro was going to be managed like the Deutschmark. We now know that that's not true. The ECB is under political control. The proof of it occurred last year, and we've seen additional evidence of that proof ever since. Whenever you have political control of the money gets destroyed. The purchasing power of that money gets destroyed, and that's what this chart is starting to show. I'm going to come back to this point in a minute. Go ahead to the next one. I want to show the boom-bust cycle in terms of what's happening relative to stocks, overvaluation and undervaluation against major stock indices, and explaining why we still have a ways to go in this current bust. As I was saying earlier, it won't end until 2013, 2015. This is the Dow Jones Industrial Average in terms of gold, and it shows the boom-bust cycle, and you can see clear cycles, the boom, the bust, boom, bust, boom, bust. Now, what's happening in the United States is not unique. Go ahead, David. This is the, I don't have the data going back to 1913 when the Federal Reserve was created, but this is the FTSE, the London stock average in terms of gold, explaining the boom-bust cycle. Go ahead. And that's the DAX. We live in a global economy. What banks do in the United States, they do all over the world. They lend and lend and lend, create the boom, create the illusions of prosperity. Too many loans are made, too many debts are borrowed, banks become over-leveraged, debtors become over-leveraged, and you go into the bust. And when you're in the bust, you want to avoid financial assets like this. You want to move into tangible assets like gold. Okay. I just want to summarize real quickly, the current situation. If you were here a year ago, January, when I spoke at the DHG event in this particular hall, I made some key points, and I showed how the gold's what I call the exchange rate. It's not the price, because you don't talk about the price of Swiss francs, you don't talk about the price of yen, you talk about the exchange rate. Gold is money, so you talk about gold's exchange rate relative to other currencies. It's rising against the dollar, rising against the euro. Okay, David. Commodity and oil prices are rising. They were rising back in January 2010 when I was speaking there. They're even rising more now, both in dollar terms and euro terms. Negative real interest rates. If you put 100 euros in the bank on January 1st, you might get 101 euros on December 31st, but the purchasing power of those euros are probably 92 euros based on the true inflation rate of what's happening in commodities and goods and services. Blind faith in central banks. Why do we believe the Federal Reserve? You know, they have such a lousy record. I mean, Milton Friedman wrote a book in 1965 explaining how the Federal Reserve made the Great Depression worse by their manipulation and attempts to do it. Yet we believe when Mr. Bernanke says he can fight inflation in a minute or take away the punch bowl. You know, the punch bowl is continually being filled by the Federal Reserve. They're not fighting inflation. They're bailing out the banks. Quantitative easing is pushing up stock prices. Stock prices are not rising around the world because of good economic conditions. You can't have good economic conditions until employment starts improving. Spain reported today 21.4% official unemployment rate. That's a Great Depression type of a number. The unofficial employment rate, they tell me, and you know, I live in the south of Spain, is closer to 34%. Runaway government spending. This is the key. Of the 16 countries in the European, in the Euro bloc, 13 of them are violating the 3% rule. We've got runaway spending all over the world. And what happens is when a government is spending too much and the market is unwilling to lend money to the government turns to the central bank and the printing press. During the Weimar Republic here in Germany, the German government, the Weimar government was spending too much money. They turned to the Reichsbank. The Reichsbank ran the printing press, and we ultimately had a massive hyperinflation with wheelbarrows. The reason why you had wheelbarrows and paper all over the place is that Germany at that moment in time was a cash currency economy. Most transactions were done on the basis of cash. In contrast, in Argentina in 1991, where I went to study what was going on in hyperinflation, you had a deposit currency economy. Most commercial transactions took place through the banking system by checks, wire transfers, plastic cards, and the like. And what happened in Argentina, when the Argentine government was spending too much, the central bank bought the debt that the government was borrowing. Nobody was willing to lend, and they added zeros to the to the Argentine government's checking account, which it then wrote checks against and created a hyperinflation. The U.S. is headed toward an Argentine-style hyperinflation, and I think we're getting very, very close. I don't know if you've been following the dollar index, but we're very, very close to its all-time low. And I've been discussing on King World News, which is an internet site, why the waterfall decline that I've been talking about in King World News began after Mr. Bernanke's press conference the other day when he was talking about quantitative easing. Everybody understands that runaway government spending in the United States is leading to hyperinflation, just like it did in Argentina in 1991, just like it did in the Weimar Republic in 1924. And lastly, I had question marks when I gave this presentation back in January 2010. The demand for currency is as important as the supply of currency. Everything in our world of economics has supply and demand, even money. And the key to understanding what's happening to the dollar and the various paper currencies or fiat currencies around the world is not so much what's going on in the supply side, even though the supply is increasing. It's what's happening on the demand side. The demand for the dollar is falling. Confidence in the dollar is falling, and it's going to continue to fall because people who are looking at the situation in the United States recognize that Congress is spending money with no discipline. The Federal Reserve is buying that debt and turning it into currency. And let me give you an example. When the Federal Reserve announced quantitative easing back in August of 2010 to the present, the U.S. government debt has increased to about $900 billion. Think about that, $900 billion. Over $500 billion of that was turned into money by the Federal Reserve. That's what makes hyperinflation. That's why the dollar is falling. That's why gold and silver are soaring. Okay, David. I want to wrap up with 4 charts. You may have seen an article that I wrote recently about this. I got a lot of criticism because I'm not a mathematician, and I called it hyperbolic rather than parabolic because this is a log scale chart. In other words, the distance between 250 and 500 is the same distance between 500 and 1,000, so you can easily measure percentage changes on this chart rather than if it were an arithmetic scale. Anyway, the point that I want to make is that the precious metals are getting ready to explode, and in fact they've already begun. The dollar's begun a waterfall decline, precious metals have begun an explosion. And I want to show the price of gold in terms of 4 different currencies. Now we all know that the price of gold is rising in terms of the US dollar. I mean, it's getting ready to explode to the upside, David. The price of gold is rising to the British pound. Note the similarity between the dollar and the British pound chart. Now, it's a good thing everyone's sitting down because, David, let's have the next one. This is the price of gold in terms of the euro. There's no difference between the British pound, the US dollar, and the euro. And the next one, David? Even the Swiss franc. It's exploding against all of the different currencies. What we have here is a historic moment. What we have here is a lack of confidence, a flight out of the US dollar, a flight out of all of the paper currencies of the world. People understand that the game is up. The ability to create money out of thin air with no discipline is coming to an end. And it's going to end in an ugly way unless you own gold and silver to protect yourselves. Ladies and gentlemen, thank you very much.
The year is 2009 and the White House is mine, but the economy is in full motherfucking decline.
Silver, the most undervalued metal in human history. Gold today is without a doubt more rare than silver. But what about tomorrow? On average today, for every 10 ounces of silver pulled out of the ground, only 1 ounce of gold is mined. However, the majority of silver mined is used for consumption, while the majority of gold mined is nearly all added to global inventory. Yet precious metal investors, as small of a group as they are still investing $7 in GLD for every $1 they invest in SLV. Looking at modern history, silver is destined to be more rare and certainly worth more than gold. In 1950, there were 10 billion ounces of above-ground available silver. By 1980, it shrank to 3.5 billion ounces. And in 2010, it is estimated that above-ground available silver supply is between 500 to 700 million ounces. To put this into perspective, total above-ground available gold in 1950 was 1 billion ounces. And today, it's estimated to be around 7 billion ounces. In 1980, when silver nearly reached $50 per ounce, global population was 2.5 billion people. Global GDP was $10 trillion, and China had the 11th largest economy. Today, global population is near 7 billion people. Global GDP, $60 trillion, and China is now the 2nd largest economy. So the population since 1980 is up 176%. Global GDP is up 500%. Above ground available gold is up 600%. Meanwhile, above ground available silver has plummeted at least by 91%, and the price is still down 46% from its 1980 high of $50 per ounce. To say the opportunity in silver is enormous is an understatement. Looking at the historical silver to gold ratio of 15 to 1, silver is highly undervalued today. It now takes 50 ounces of silver to purchase 1 ounce of gold. Even when ignoring the above ground supply deviation, mined metal production should at the very least bring that number to 10 to 1. Using today's prices with gold at $1,400, silver should be worth no less than $140 per ounce. Silver is being consumed more than ever, and it is a fact that there is less above ground available silver than there is gold. Industrial demand for silver is up 18% in just the last year. The need for silver is growing by the day. Silver is being consumed and used for bandages for wound care, batteries, brazing, soldering, catalytic converters, cell phones, computers, satellites, high-tech weaponry, lasers, digital technology, clothing, electronic circuit boards, ink, solar cells, water purification, wood treatment, antennas, RFID chips, freeway toll transponders, passports, and the list goes on. From 1990 to 2000, nearly 2 billion ounces of above-ground available silver disappeared to consumption. Yet industrial demand for silver was only 35% by the year 2000. Today, it's 54%. And looking at the new uses for silver, the silver production deficit will only widen. China, since 2003, has been growing its solar energy base by almost 100% every year. By 2014, the world will need 130 million ounces of silver just to satisfy 1 year of global solar demand. The world has consumed so much silver in the last 50 years that the last time above ground available inventory was this low was 1300 AD. The deficit of silver production has been met mostly from government stockpiles. The U.S. has dumped nearly 5 billion ounces since World War II into the silver markets. But as of 2010, according to the USGS, a government stockpile for silver are listed as none. The supply and demand deficit continues to be ignored by global investors year after year, decade after decade. Total mining production for 2009 was 710 million ounces. Total demand was 889 million ounces. That's a mining production deficit of 179 million ounces to meet demand. With each day comes a new use for silver, and the supply and demand deficit continues to eat away at the above ground available supply. FutureMoneyTrends.com is projecting that just as palladium was once worth more than platinum, silver will one day be worth more than gold. The demand for silver will continue to increase, yet mining production will never be able to keep up, depleting the above ground available silver supply possibly by the end of this decade. Silver may be the greatest investment in human history. How often doesn't any generation get the opportunity to invest in a finite resource that will soon be extinct?
One of the things that we've put together as a little display for some of our clients is a series of 27 official notes. This is currency from the country of Zimbabwe. And if you take a look here, this starts out at $1, and the date on it, I don't know if you can zoom in and see that or not, David, but in 2007 they had ones, and then of course 5s, 10s, and 20s, and this was the currency that was being used. As we well know, what happened is the hyperinflation started to kick in, and they started to print higher and higher denominations as people demanded more and more currency, and so they got up into the 500s and the thousands. We're still in 2007. Here in 2008, they started printing in the tens of thousands. So in a period of less than 1 year, we went from 1s, 5s, 10s all the way up to 10s and 20,000s. You start looking up here and 50,000, 100,000, 500,000, and $1 million bills, and it just kept going and going and going. Let me show you over here. We get the billions of 1 and 5 and 10 and 20, and then here's a $50 billion bill. On July 4th of 2008, a can of Coke would have cost you $50 billion for breakfast. But at lunchtime, it would be $100 billion, and by the time you got to dinner, it would be $150 billion. their inflation rate, as you know, was approximately 10 to the 27th power. It's something that's just staggering. And by the time they started printing, they just said, well, forget the billions, let's just go to the trillions. So they started printing 10, 20, 50, and $100 trillion notes. They hired a German company to print these, and they placed the orders for these, and by the time the German company was finished actually printing them, they weren't worth the paper and the ink that it took to make them. And so the German company never delivered them. They were never circulated. So these are all, uncirculated banknotes, but it illustrates how fast, how quickly, and how devastating hyperinflation can be. From 2007 to 2008, in a period of less than 2 years, about 1.5 years, the currency imploded, and now they don't even have a national currency in Zimbabwe. They now use hard currencies, gold and silver. So,
quite a lesson, and one I hope no one misses that lesson. Thank you so much, Reed.
Thank you, Dan.
Buy real, get real, be real.
The following is a fictional story of events that may happen in the near future. 8 a.m. New York Stock Exchange. It's a cold, breezy day on Wall Street as markets await the Federal Reserve's announcement for QE4. Futures are up significantly. The Dow Jones just breached its 2008 high of 14,164. Gold just hit an all-time high of 2,900. Silver just breached $100 per ounce. The dollar index is holding at 53. With official unemployment at 16.3%, there is a nervous feeling on Wall Street that if this doesn't work, the world could implode into a depression that will last for the remainder of the decade. 8:19 a.m. Beijing. Chinese officials announced that they can no longer allow Washington to devalue their holdings. After making their concerns private, China accepts that Washington will never stop paying its debts with inflated currency. China makes an official statement from Beijing, quote, "We have made our concerns known privately for some time. With QE4 about to be announced today, China will have no choice but to stop purchasing U.S. treasuries. We have allowed Washington to try to work through their imbalances for 4 years. But with global inflation and U.S. consumers rapidly shrinking as a percentage of global GDP, we feel that a Western recovery is unlikely until they reform their entitlement programs." 8:45 a.m. New York Stock Exchange. Upon hearing the statement from China, Dow futures have a sharp reversal and begin to drop. Gold leaps past $3,000 per ounce, up $150 per ounce in the last 26 minutes. CNBC awaits a statement from the White House. 8:50 a.m. Washington, D.C. The president makes an official statement to calm investors' fears. He tells Americans that he has spoken with several G20 leaders. They have assured him that they will continue to increase their purchase of treasuries and believe that a strong U.S. economy is the only thing that will bring back global prosperity. He has also spoken to Chairman Bernanke, who assures him that a strong dollar will be the result of QE4. The president also reminds Americans that his recent New Deal recovery programs that he passed through executive order will increase the likelihood of a lasting recovery. He also notes that Beijing, since 2009, has slowly been reducing their holdings, so the impact will be minimal. 9:51 a.m. New York. Dow futures fall 850 points in the first 20 minutes of trading. Markets are halted for 1 hour by the authorities. 10 a.m. Main Street, America. The news about the stock market in China has now spread. A panic begins to sit in and unprepared Americans rush to the grocery store. In an attempt to purchase food and water, Americans that didn't know what was going on are alerted by all of the news stories and panic buying. Within 50 minutes, there is a nationwide rush to the stores. Empty store shelves in America become a reality. 10:52 a.m. New York. Markets reopen and the Dow Jones resumes its collapse. Investors around the world join the sell-off in bonds and stocks and begin to purchase commodities. Unlike the panic of 2008, this time commodities are seen as the only safe haven from a dollar crisis. 11:30 a.m. New York. The Dow falls 1,700 points since reopening. Trading is halted for at least 2 hours. The Federal Reserve injects $200 billion into the markets and announces that QE4 will be delayed until further notice. Congress is called back to D.C. for an emergency joint session. Some members of Congress are saying that they consider China's statement a financial attack. 12 p.m. Main Street, America. Several cities begin to see civil unrest after grocery stores are forced to close. Traffic in the streets and violence break out. The president puts the National Guard on alert for a possible deployment onto U.S. streets if things don't get under control soon. Several news agencies are reporting injuries at grocery chains and call for the authorities to do something before it gets worse. 12:15 p.m. Toronto, Canada. George Soros tells CNBC that a run on treasuries is imminent and that there is nothing the government can do to stop it. He says it is unfortunate that a controlled decline of the dollar was not coordinated better over the years. Today really could have been avoided if not for the Tea Party politicians who demanded fiscal responsibility and a constitutional government. 3 p.m. Gold closes at $11.53 for the day at $4,053 per ounce. Silver closes at $173 per ounce. The president announces that due to civil unrest in some areas of the country, U.S. stock markets will remain closed for the rest of the day. With the exception of mining and other inflation-related stocks, the majority of U.S. stocks are down significantly due to the sell-off and flight to safety in commodities. The Federal Reserve announces that it will begin to purchase U.S. treasuries and stocks in order to stabilize the markets. But this only feeds investors' fears of a full-blown treasury run and collapse of the dollar. 6 p.m. Asia. Asian markets begin a massive sell-off. Dollar collapse rumors begin to take hold of the markets. CNBC Asia looks into a possible COMEX default and complete breakdown in the U.S. economy. Gold spikes in Asia, up 17.50 in the first complete hour of trading. Gold is now at 58.03. 7 p.m. Gold and silver bullion dealers across the world have suspended all sales due to no inventory. A COMEX default is now expected. Several central bank representatives propose a freeze on currency markets and a fixed devaluation of the US dollar in order to calm investors. 7:30 p.m. the United States. The sun sets on America. In the last 12 hours, the world has changed. Americans are glued to their televisions, taking a crash course on a debauched currency. Smoke from fires in the cities have put a dark cloud over the nation. 7:45, the Federal Reserve. The Federal Reserve announces it will inject $1.5 trillion into the markets in order to stop any further decline in stocks. 7:55 p.m., OPEC. The final nail in the coffin. OPEC nations halt oil trades in US dollars until further notice. They will only accept euros, renminbi, or gold. 7:59 p.m. The Federal Reserve's announcement to inject $1.5 trillion into the markets causes a sharp reversal in overseas markets. Stocks begin to rally even as Main Street melts down. 8 p.m. Manhattan. Gerard Adams, president of the National Inflation Association, sends out an urgent email alert. In it, he informs members that it is with great sadness that the time to warn and prepare Americans for hyperinflation has ended.